We have developed 3 new lump sum benefits which can be mixed and matched with our standard life, TPD and trauma covers to give your client's business the insurance solution that best fits its needs. The purpose of the 3 new benefits is to protect the business against the financial impact caused by the death or long-term disability of key employees or sole traders. The 3 new benefits are as follows. Shareholder buyout cover. This new benefit is designed to fund buy-sell agreement commitments in the event of the death, terminal illness or long-term disability of a shareholder who is actively working within the business. This benefit will not be available to sole traders. Debt protection cover. This new benefit is designed to fund business debt repayment upon the death, terminal illness or total long-term disability of any employee, shareholder or sole trader where this event would trigger a requirement for the debt to be repaid. Permanent loss of key person cover. This benefit is designed to provide a capital injection into the business upon the death, terminal illness or total long-term disability of a key employee or sole trader of the business. The unique feature of these new lump sum benefits is the events that trigger the payment. The death or terminal illness of the life assured, or the life assured suffering from any illness or injury which leaves them totally unable to do their job for 3 months and is confirmed as likely to last at least a further 6 months, and as a result of the prognosis, their active engagement in the business formally ends. It is important to note that there is a small list of conditions where the prognosis must be likely to be permanent rather than just 6 months into the future. These conditions are fibromyalgia, fibromyositis, fibrositis, muscular rheumatism, myofascial pain syndrome, osteoarthritis, wear and tear or any other subjective diagnosis of a musculoskeletal condition without conclusive diagnostic test evidence, chronic fatigue syndrome, epidemic neuromyasthenia, myalgic encephalomyelitis, post-viral fatigue syndrome, chronic pain syndrome, glandular fever, loss of sight, loss of hearing and loss of speech, any mental health condition. So this benefit differs from standard TPD, which requires all prognoses to be total and permanent before payment can be made. It also differs from trauma, which only pays if the life assured suffers one of the listed conditions and then pays the sum insured, irrespective of the financial impact on the business. Our new benefits will pay as soon after the initial 3-month period as we receive the prognosis that the life assured will be unlikely to return to work within the following 6 months from most conditions, not just those covered under trauma. It is important to note that this could happen immediately after the initial 3-month period, or it might take some months before a prognosis of a further 6 months off work can be made with any certainty. We believe, on balance, that this trigger is more closely aligned to the likely timing for the following key business decisions and therefore gives the business owners more certainty about outcome. The buy-sell agreement being enforced, the business debt requiring repayment, the business having to fund the replacement of a key person or sole trader, the business having to be sold or wound up, the requirement for life assured's active engagement in the business to be formally ended protects us against selection risk and is appropriate given the purpose of the funds. The only exclusions that apply are the standard 13-month suicide stand-down period for death and self-inflicted harm for long-term disability. It is important to note the conditions which apply in relation to benefit expiry, which I will outline for you now. The life and terminal illness covered condition automatically ceases when the life assured has reached the age of 75. The total long-term disability cover condition automatically ceases when the life assured has left the employee of the business, except of course if their employment ends due to long-term disability, or, in the case of a sole trader, wound up or sold the business or not been actively engaged in the business for more than 25 hours per week on average in the 3 months immediately prior to suffering long-term disability, or, in the case of an employee, been on a period of leave without pay for more than 2 consecutive months immediately prior to suffering the total long-term disability, or been incarcerated in a penal institution immediately prior to suffering the total long-term disability, or reached age 70. We recognise there may be circumstances where the new lump sum benefits are not required. For example, if only the death of a shareholder would trigger a share purchase under a buy-sell agreement but not long-term disability. This might happen if the shareholder is not actively engaged in the business. We have, therefore, allowed these covers to be included under the business protection plan at your discretion. These standard benefits are explained in more detail in separate video clips. The business protection plan is designed to financially support businesses when there is a financial impact due to an unexpected death or illness of a shareholder, sole trader or key employee. It is not a financial safety net or escape for businesses who are financially troubled due to other circumstances. As a result, the policy will automatically cancel if the owners of the business are bankrupted and, in Partners Life's opinion, this bankruptcy will have a significant impact on the ongoing viability of the business is placed in receivership, the business is liquidated, the business is wound up, a court order is granted for the winding up of a business, or the creditors of the business are compromised. Given the nature of this cover, there are some restrictions based on residency. Coverage under the debt protection, shareholder buyout and permanent loss of key person benefits is only provided if the life assured permanently resides in New Zealand or Australia. So, shareholders, sole traders or employees who permanently reside elsewhere cannot be covered under these benefits. We will consider a claim if the life assured is temporarily outside of New Zealand or Australia because they are travelling on business, travelling for vacation, or undertaking a temporary assignment for the business. Worldwide cover applies as usual for any life, trauma or TPD benefits included under the plan. Because the debt protection, shareholder buyout and permanent loss of key person benefits cater to businesses whose profits can fluctuate wildly over the course of each year, there is no automatic or optional CPI indexation that will be applied to these new lump sum benefits. Automatic CPI indexation applies as usual for any life, trauma or TPD benefits included under the plan. A business future insurability option can be added to each of these new lump sum benefits for an additional premium. The option allows the sum insured to be increased without further health assessment of the life assured. The triggers for exercising the option differ depending on the type of benefit. For shareholder protection cover, the trigger is simply an increase in the life assured shareholding in the business or an increase in the value of the shareholding. For debt protection cover, the trigger is an increase in any business debt which is at risk of being called if the life assured dies or suffers a long-term disability. For permanent loss of key person, the triggers are the value of the business increasing, or the key person's value to the business increasing through an increase in role, responsibilities or specialisation, or the cost to the business of replacing the key person or sole trader increasing due to an increase in the market demand for their particular skills. Exercising the option is simple. Just provide formal proof of the trigger, such as the share valuations, loan agreements, employment contracts, etc., within 180 days of the event. There is no specified limit for each increase. They are simply relative to the increase demonstrated by the applicable proofs. There are, however, some limits to the total increases allowed under this option. The total of all increases cannot exceed 5 times the original sum insured. The option ceases when the combined non-life lump sum cover with Partners Life reaches 6 million for that life assured. There is no limit to the number of times this option can be exercised. It is important to note that this option cannot be exercised in the first 6 months and ceases at the policy anniversary prior to the client's 60th birthday. The most recent acceptance terms will apply to each increase under this benefit. Each of the lump sum benefits is designed to protect a different business need and may require specific ownership. For example,
the best founders and the best companies want to stay private longer. Obviously, they do go public, but the stage and the timing at which they do that has been pushed back a lot. So now you see businesses doing hundreds and hundreds of millions of dollars of revenue that would have been public far earlier than what they are, and they're still private. And so what you've seen is from both ends of the investing spectrum, whether it's the VCs that would do seed stage, Series A, very early investing, what they've gone and done to respond is they've raised growth funds because they were backing these great companies at the Series Seed, Series A, Series B, and then they wouldn't invest anymore. And they wouldn't invest because the company might only be a year or 2 years away from going public. So they just did their early stage investing. Company would go public, then you would see all the mutual funds, long only, sovereigns, etc., buying the stock and holding it in public markets. That was basically how it worked. Now, those same companies, aren't raising a Series B or C or D and then going public. They're raising an H or an I or a J. The letters just keep going further into the alphabet. And instead of doing 30 million or 50 million of revenue and going public, they're now getting to 600 million of revenue and going public. So from the other side of things, those same investors that I mentioned by category who would buy the stock at the IPO and take over from there, they're now saying, well, hang on. Those companies that used to IPO when they'd hit, let's just say, $30 or $50 million of revenue, well, they're now staying private, and they're staying private for a lot longer. And by the time I see them in the public market, a lot of the growth is gone. They're not growing at 120% sales anymore. They're now growing at 60, for example, because they're just more mature, later stage businesses than what they used to be when they list. So those same folks are now raising growth funds, and that's why you're seeing folks like Coatue, Tiger Global, etc., that were traditionally public market tech investors. They're now becoming private market investors or crossover investors, as they're often called. You're also seeing sovereign wealth funds, whether it's GIC, ADIA, ARDIC, Temasek, etc., these larger sovereigns. They've got big direct investing teams plowing money into Series C, D, E, F all the way now. So in a lot of ways, everyone's almost converged into being just a sort of across the financing spectrum capital provider to companies. Tiger is now doing Series A, and they're also doing public. So everyone's sort of playing there. So where I spend my time is Series C to pre-IPO. So I don't do public, and I don't do the early stage venture type investing, taking venture risk at the seed AB. I'm in that Series C to pre-IPO, where a company might be doing, let's say, 20, 25 million of revenue all the way up to hundreds of millions. That's what I do.
And so it's basically, it's not these sovereigns and traditional funds going early stage. It's just the companies are coming out into the public arena later, and so they kind of have to change the way they think about investing and move with the times if they want to still have a growth company that's growing at 100, 120% rather than a 10 to 15% once the revenue's already, billions of dollars.
That's right.
So because I guess one aspect that you do get a lot of is, hey, these companies are taking more risk, but in actual fact, they're not necessarily taking more risk in the companies they invest in. The only thing they're doing really is perhaps thinking about, the liquidity, but that's also where the value is, because there is a liquidity premium by going into a company that before it lists, isn't there?
That's right. And if you look at the performance of a lot of these companies, if you own them a year before the IPO or 2 years before the IPO, there's, whether it's a Snowflake, there's a lot of examples, but Snowflake, for example, that one, if you were in it just 1 year before the IPO, your return versus coming in at the IPO was just completely different. You could, if you looked at both sets of returns, buying Snowflake shares 12 months before the IPO, buying Snowflake shares at the IPO, and looked at the two returns, you would never think it's the same company. Yet when you look at the business risk, there's no difference between the company, between the two situations. Both mature, nothing changed 1 year versus the next, yet the returns are so different. And that's because by the time these companies get to the IPO, they're so often so rich at that point because there's been so much money put in, they're so bid up already, it's just too late. So everyone's kind of moved earlier so that you can still get interesting returns. By the time something's IPO'd and then trading, the truth is it's pretty fully valued a lot of the time. That's just, the public markets are pretty efficient. So if you're buying something that's, been trading for a couple of weeks in public markets, chances are it's pretty full. Whereas you can find some, I think, really interesting transactions, investments to do when something's a year, 2 years, 3 years from its IPO. You can do some interesting stuff.
So the next part of it, which is quite different, is there's these, rounds where these companies raise capital, series C, D, E, all the way, like you said, down to H. But the other part of the market where you can buy an exposure is through the secondary market. Now that's a little trickier because that's all about relationships. But when I take a step back and think, some of these great companies and you've got people selling their shares, whether insiders, some of the management team or whatever, selling their shares prior to IPO. Why would they do that? Because this is the market that you can take advantage of and be nimble in. But the fact that there's even a market like that is sometimes surprising, given some of these people are sort of giving up value prior to the IPOs. Can you talk us through that?
It's just diversification. So, for example, with our fund earlier this year, we bought 2 clips of Toast shares. The first one was at $25 a share. The second transaction was at about $33 a share. So it was in April and May or June. That was the timeline this year. I think it closed in the high 40s. It's traded in the low 60s. So, let's just call it up 70 to 90% from our cost basis in 6 months. So an IRR of well over 100%. So you might say, well, why would someone do that? Why would they sell you those shares? Well, number one, it's not guaranteed that's going to happen. So there's risk. Now, it worked, and that's great, but there's risk. Secondly, the individuals we bought from, I won't say too much, but they were employees. They had significant stakes, meaning well north of $50 million worth of shares, well north of that. And so when you look at their risk profile, let's just say someone owns $50 million of shares. If the company doubles from there and they sell 10 million, they still end up with $80 million worth of shares. So they've done pretty well. But if things don't go well, at least they've taken $10 million off the table. That's how they view it. And by the way, it's not like the $10 million has to sit in cash. They can get the $10 million and buy real estate or Amazon or other things. It's just diversifying. And really for a lot of these people, it's, hey, I never had any money before. Now I'm worth 50, 20, 80 million bucks. They get a private wealth advisor. The private wealth advisor talks about tax planning, diversification, et cetera, making a sale before the IPO for partial liquidity is a very responsible thing to do. So most of them do it now. And it creates, for us at Goanna, it creates an additional sourcing mechanism where we don't just rely on going to the company and investing in one of their primary rounds and putting money on their balance sheet. We can and we do that. But what we also do is we go to the stockholders, whether it's the early investors, former employees, current employees, and we offer them liquidity. So we have those two mechanisms to get exposure to all the companies that we like and build a portfolio. And so it works really well. And the most interesting part about it is because someone might only be selling, say, 10% of their holdings, they're not that price sensitive. They really just want a good, reliable investor who's going to close the deal with them, et cetera, and give them a good experience. So they're not that price sensitive, which is good, a very good thing for us because we can get some good deals out there.
Well, that's a good segue, Rob, into the actual construction of Goanna Fund 1. It's made up of, a number of these great companies where you've mostly, it seems like, got them off the secondary market where you're giving a good, reliable partial exit to employees and founders of these businesses. When you think about the diversity across that Fund 1 portfolio, what are some of the companies that we could see in there, and what are some of the names that are now coming, either have already listed or are on their way to be listed?
Yeah, so we've been very fortunate with Fund 1. I talk about Fund 1 because we're closing Fund 2 now. So we're very fortunate with Fund 1 to have already had 4 IPOs out of a portfolio that we've only started investing this year. So clearly a pretty liquid, type profile for the same year of investment. So we had Confluent, which is an amazing software business. They IPO'd. We paid $25 a share there. I think it's trading usually in the 70s per share. So we'll have our shares unlocked and distributed next month. So that's been an amazing outcome. Toast has been an amazing outcome. So we were also in the Robinhood Convertible, where that security was amazing. They've obviously IPO'd. But what was amazing there was all we did was convert at the IPO price at a 30% discount. So wherever they IPO'd, we were going to convert at that IPO at 30% cheaper. So it's been pretty volatile, obviously, the Robinhood stock, but our cost basis was $26.50. So even through all the volatility from, I think it traded up at like 60, 65, spent a lot of time in the 40s, now it's in the mid to high 30s. Even with all that volatility, we were still up 20, 25% because our cost basis was $26.50. So that's an example of just a really great security you could come into before the IPO rather than paying the IPO price, which was, in the high 30s. And at some points you were underwater after the IPO. So whereas because we got into that security just a few months before the IPO, we stayed sort of in the money, so to speak. And all those shares will be distributed within the next week and a half in Robinhood. And we've already had one distribution there from Robinhood. So it's been a really good year. Our IRR is net about 50%, both for the companies that have IPO'd and just the overall portfolio. So there's a lot of amazing companies in there. We invest across cybersecurity, fintech, healthcare, and data, which we think are the generationally most important companies as we look over the next 10 years.
And your role, I guess, with your team is to, one, analyze the ones that you want to invest in, but also, I guess, it's part of this is getting the investors who want to sell over the line and sourcing the stock and executing on each of the individual deals. So I guess in some ways it's quite a difficult process to replicate, and that's why not everybody is out there doing it. Would that be a fair?
It's a hard model in the sense that, look, if someone came to me and said, what's the best business you could build as an investment manager if you just wanted an easier life and to make a lot of money, the better thing to do, I'd say don't do what I'm doing. What you should do is you should raise a huge amount of money and just do primary rounds. And the reason I say that is the primary rounds are very well advertised amongst the better investors. So amongst the better investors in the US, hey, Databricks or Stripe or whoever, we're raising our Series G. It's going to be a $500 million round. It's coming together. Okay, everyone goes into the data room. It's just a very, pretty predictable, reliable method of financing. And so you can invest reliably, with bigger checks and do less work, because you can put a bigger check in each time and just plow money into a bunch of companies over the year. That's your primary round. We do those, but we also, as I said, do a lot of these secondaries. The secondaries are hard because the person could change their mind. You're negotiating a deal and they say, actually, you know what? I got a better price over there. I'm not going to sell. I'm going to wait 3 months. So you have to be negotiating a lot of these transactions all the time. They're all high touch, but it's worth it because they're most often better deals than the primary round, because they're not competitive, they're not well advertised, you're not competing with 10 other investors to be in the round. It's a very good dynamic when you're in these. So they're worth doing, but they are high touch, but it's not all that competitive. And so, for that reason, the annoyance reason, I mean, there's not a lot of firms that do what we do. And so, it's working at the moment.
And Rob, one question would get a lot of is around liquidity, and I think it gets unfairly compared to, say, private equity, where you are literally buying the business, and in order to get liquidity, you have to sell the entire business, warts and all, all the HR and all that involved with private equity. This is different, isn't it? If you want to exit one of your positions, even though it still hasn't IPO'd, the ability to do that is relatively simple and straightforward.
Yeah, so the way to think about it, it's turned into a really interesting asset class, because it's like a hybrid of listed equities and private equity. It's a hybrid where, yes, it's private, yes, it's unlisted. So yes, you can and should earn a liquidity risk premium. And it's more opaque, it's more fragmented, which means it's less efficient. More inefficient markets allow you to try to find some investment opportunities where there's some degree of asymmetric risk reward. That's ultimately why one is in private markets versus public markets, where public markets, very efficient, endless transactions all day, lots of market participants discovering price, etc. The reason I like this area of private markets, though, is you're not investing in a idiosyncratic single business that no one's ever heard of, that doesn't trade. That's true private equity. Incredibly illiquid. I've never liked that. What we're investing in here are actually relatively liquid, even though they're in private markets. And what I mean by that is I could send an email out today. So the portfolio has shares in Kraken, for example. I don't know if they're in New Zealand.
Kraken's the cryptocurrency sort of platform, isn't it? Really, really popular in the US.
Yeah, it's big in Europe and the US. So do you have Coinbase there?
I'm sure most people have heard of it, but there's a few sort of New Zealand-centric platforms, but similar to Coinbase.
Okay, got it. So Coinbase is the biggest crypto trading platform, certainly in the US. Kraken is the number 2, but Kraken's huge in Europe as well. And so I'm just giving an example of one where we own it in the fund. The shares are very liquid. I could send an email out today, and probably by, depending on the price I want, but certainly by midweek, be signing transaction documents to sell the shares. 2 to 3 days. I could sell them tomorrow morning if I really wanted, but if I wanted a pretty big price, but a fair price, I could probably be out in the next 2 to 3 days. No bankers, standard set of docs, bang, DocuSign, out, done, sent it to the company to update the share registry. That's pretty unique. And so it doesn't apply with that velocity to every single situation necessarily. But the point is to be in private markets with a liquidity profile of that nature, where I can decide today to sell and tomorrow to be signing docs with a counterparty, that's pretty unique. And so that's why it's, I think, particularly interesting, especially as you think about a portfolio and allocating capital on more of a portfolio level. It allows for a larger allocation of those dollars in the portfolio to the asset class, because of the embedded liquidity. And so whereas ordinarily you'd really keep that allocation smaller because of the illiquidity, if it was true private equity, you can actually grow that allocation because they can be both liquid while private, but also a pathway to liquidity in the form of an IPO regardless. So it's just a very interesting asset class.
And I think that's a perfect explanation of why, we wanted to get into it, is that there's all this value to be made prior to the IPO. And, there is in private equity too, but the liquidity and the lack of it in private equity means it can be difficult, especially in times of high stress where the company's having an issue with its earnings profile and, you're stuck in it for the next, could be 10 years. And that's probably a good segue to move on to the next point is, it doesn't mean to say that there's not value to be made in IPOs. So why do some IPOs, do you think, this is a pretty difficult question, but why do you think some IPOs are successful and some sort of crash and burn, the IPO crash and burn, not necessarily the company, but I'm sure the company in both cases is still high quality, but is that just because a lot of the value's been stripped out already, or is it just the process? And would you ever participate in an IPO, or do you think at that point it's just too much of a risk?
No, I definitely plan to participate. The other great thing about being a private market investor, and this is probably one of the least appreciated aspects, so I almost forget about it, quite frankly, sometimes, or should I say forget to bring it up. But by being a private market investor, I get to know these companies before most people have heard of them. So with Toast, for example, I knew the chairman of the company years ago, and buying stock earlier in the year. So obviously when they come to IPO, the C-suite knows Rob. They know who I am. So they can allocate stock to me far more than they would if they didn't already know me. And you can develop these relationships 5 years, 4 years, 1 year before the IPO. And that's a competitive advantage because, the bankers seem to continue to price these IPOs a little cheaper than intrinsic value. And so there's a monetization there on the table simply because you're investing earlier. So that's a benefit. In terms of participating in IPOs, I think it's hard. It's not obvious anymore that just playing the calendar makes money. Usually it does, but it's not that obvious anymore. And you're right. The reason is the companies are relatively mature by the time they IPO, and they are pretty relatively full in value. So just buying the stock at the IPO, unless the bankers just give you a gift, well, it's not obvious. And if you take it over 3 or 6 months, where it can trade up and down, and there's a first sort of earnings report you have to own it through, these things get very volatile. So I think I'm just always looking at public markets, and I look at very closely each week. Just what a very simple measure is that I look at each week is what's the median forward multiple on revenue the market's paying for a given sector and the top 5 companies in the sector. So, for example, if you look at cybersecurity, so you've got a few big ones there, but SentinelOne and CrowdStrike are 2 just very well known poster child, particularly CrowdStrike. The forward multiple on revenue that the market is still paying for these businesses is huge. I'm talking 40 times forward revenue plus, at least 30 times forward revenue plus, the big multiples. So you can sit here today and say the market still wants to own these companies. So that informs me both in terms of where should I spend my time for companies that are, say, within a year from the IPO, but also in terms of what might be interesting at the IPO. And so it informs both points. And so to give you an example, we have in Fund 1 a company called Netscope and a company called Arctic Wolf, both big cyber security companies valued at 5 billion plus IPOing next year. And so I think based on what the market's doing today, those will do really well. So depending on where they price, but I'd be inclined to be involved there. But that's really how I think about it. So I keep a pretty close eye on this stuff every week.
I mean, that's an amazing example. So, Arctic Wolf being valued at sort of 5 billion plus, and it hasn't even IPO'd yet. We're talking about on the New Zealand market, that would be in the top 10 listed space in the entire New Zealand listed market. It shows that these companies aren't small technology firms. These are large massive established businesses that are just creating value prior to their listing, which is just a phenomenal change to how I guess we got used to things 10 years ago or even 5 years ago.
That's right.
The final thing I want to talk about before we let you enjoy your Sunday Arvo is Fund 2. So Fund 1's been a great success. It was your first foray into raising money from investors. What's in store for Fund 2? Are there any companies within that you can talk about that you've got your eye on, and what's the plan? Is it more of the same?
Yeah, so Fund 1 was a very good performance. It's been a busy year. So Fund 2 will be closing it shortly. We'll begin deploying the capital in January over a 2-year period. So that's when we'll be deploying. We'll be deploying into Series C to pre-IPO, and a very nice blend across industries. So fintech, cybersecurity, healthcare, and data. So we'll be spread across those verticals of tech from Series C to pre-IPO. And in the portfolio, we'll probably have in the realm of 30 to 35 companies in the fund. So quite diversified across where, maturity of business, vertical within tech, timeline to IPO, and just number of companies. So quite diversified. In terms of some names we like, I can't give you all the secret sauce, but I think two that really excite me are, quite frankly, the two that I just mentioned. If you just put Netscope into Google, Sequoia led the round about 3 months ago at, I think it was $8.5 billion in change valuation. I think that can be a $15-20 billion business next year at the IPO, so maybe higher. I'm hopefully going to be in their pre-IPO round. So they'll do. I don't know when in the year they'll IPO, but they're going to do a pre-IPO financing, get some capital in, and then go out at some point thereafter. So I'll be in there, and then Arctic Wolf. I think that's just a really, really strong cyber business as well. So that's where I'm spending a lot of time. But I think the fund. I'm very excited about the fund because ultimately for investors, which clearly you're one, my goal is always to buy companies at the right price, but be picking companies where I genuinely believe in 5 years or 10 years, people can still own those companies and say, wow, that's a really important business to own in a portfolio. And what I'm really doing is getting that ownership for people earlier on at good prices. So Toast is one where I believe people could own it in 5 or 10 years and say, wow, that's a big business. That's a really important business. How did we get long those shares? Through Goanna.
I would say it's exactly why we're going to commit to Fund 2 as well, because it gives you this, and like you said, it gives you a great access to these companies, and also you get to know these companies before they IPO. So once they do and you want to get set with a bigger position, you already know how they operate, you know how they report, you know what are the key drivers, and you can just launch straight into it. Rob, I'm going to ask you one more cheeky question before I get Andrew on board and let you go, even though I said already that this was one last question. That was Allbirds. I know it wasn't in your fund, but did you have any thoughts on it? I mean, the IPO went amazingly well, is that the sort of company that there was stock available prior? And do you know much about the story or how people would have assessed the IPO to sort of push it up 100% on the day of listing?
Yeah, it was just a familiarity question for me. So with Fund 1, I really stuck to, generally speaking, businesses that I already knew a lot about before this year. I try to invest in companies where I have done the work already and then just refreshing. So that's just how I approach things. And so it just wasn't one I'd done the work on. I didn't have any of the numbers, hadn't met management, hadn't looked at it before, hadn't seen how it's traded over time, etc. So I just didn't know it very well. I think that, look, the great thing about consumer businesses is if they work, and quite frankly, I don't do a whole lot of consumer. As I mentioned before, I'm more fintech, healthcare, cybersecurity, and data than I am consumer. So I don't want to say too much because I'm sure I'll say things that are incorrect and not insightful. But what I can tell you about consumer is the end markets are huge. So if you're talking to someone who this is just my gut feel, I would never invest, just as personal views, I would never invest really early in a consumer company. I'm talking like seed or Series A. However, once a consumer business, like an Allbirds, once they start to inflect, and you can see they've inflected with sales and hiring and branding, blah, 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 then you go in. Because the end market they're addressing is huge. So a Lululemon, for example, everyone always underestimates the size of their end market. Huge company that exists there with Lululemon. So I'm not surprised that it's done really well. I can't really comment on any of the numbers or is it fair value. I don't have any idea. But what I can say is once these founders, and the founder is a Kiwi if I'm not mistaken.
Right.
So if you've got a great founder and they've inflected and you just have a view that the end market is a good one and they can land and expand with the consumer, etc., it can work really well.
Rob, great insights, and look, really appreciate your time. Excited about Fund 2. Just to remind everybody that the growth portfolios will be do have a small position in Fund 1. We'll be supporting Rob and his team in Fund 2, and we're really looking forward to the journey into this market because I think it's becoming ever more important to be able to create value prior to some of these big technology and fast-growing companies listing. And it's great to be partnered with you, Rob, and appreciate your time.
Absolutely. Bye, mate.
Take care. Cheers. Well, that was a great intro, Andrew, into Allbirds. Thankfully, I put Rob on the spot there, so thankfully he didn't sit there going, I'd never invest in it, but we did participate in the IPO, which is where we thought the value would be created. And it was a really good point about that in market size. But without going into it too deeply, from my point of view, you've done the analysis and you wrote a incredibly nice looking, at least, research report. We've certainly upgraded on that front. Can you talk us through the Allbirds investment thesis and what happened?
Yeah, it's interesting. Rob touched on 2 points about Allbirds without knowing the company well, and both of those points are 2 parts of our investment thesis. So we'll get to that and talk to that in a little bit more detail. I'm assuming most people on this call at least have bought an Allbird pair of shoes or are familiar with the brand, but just to cover off anyone who doesn't, Allbirds has positioned themselves as a global lifestyle brand that innovates with natural materials, and the purpose is to take these natural materials and design comfortable footwear and apparel in a manner which is very low carbon footprint for the planet. The most iconic shoe that they've got at the moment is what they call their wool runner. This came online in 2016, a year after the company was founded. And this shoe was also named in that same year the most comfortable piece of footwear by Time magazine. And is using completely natural materials. They use merino wool on the fabric of the shoe, and then the sole is made out of a blend of natural fibers from wood-based and sugarcane products, which makes also a comfortable sole, but also one that has been created in a carbon-free manner. The reason we're talking about Allbirds to you today is that it IPO'd 2 weeks ago, as James mentioned, and it had an absolutely amazing day one IPO. The stock price was up 92% in day one, and it exceeded our expectations. We thought the valuation was really attractive at IPO, but we didn't think it would go up 92%. Since then, it's actually come back a little bit. It's probably pulled back about 25 or 30% from the highs, but it's still sitting about 40% above the price in our IPO. Just a little bit more on the background of the company, and I think the connection to New Zealand. The company was founded in 2015. It was co-founded by two people. One of them was a guy called Tim Brown. Now, he's a New Zealander that was a professional football player and also played for the All Whites. He partnered up with a friend of his, and a friend was based in the US, and that friend was an expert in renewable products and materials, and they got an introduction. I think it was between their wives that knew each other, and they introduced the two of them. They got together, and Tim was passionate about shoes and trying to make shoes in a better and more comfortable way, while Joey Zwillinger, the co-founder, was really passionate about renewable materials. So they got together, got thinking, and they started looking at how they could use natural fibers and products around the world to produce comfortable footwear. And it only took them a year or two to get it going, and then straight away, as I said, they had, according to Time magazine, the most comfortable piece of footwear in the world. Since then, the growth story has been absolutely amazing, and it's incredible to see how two people with a great idea can start with pretty much nothing and then create a business which is selling over $200 million worth of shoes in only 5 years, and listed on the NASDAQ stock exchange with a valuation of over $3 billion. And I think that's sort of where one of the points Rob mentioned is interesting. You might be nervous about an early stage consumer product, but once they hit that inflection point and they show that they have a proven model that can take off and do very well, then the business becomes very exciting from an investment perspective.
That's a really good point, Andrew, in terms of often you can see the valuation move up dramatically and totally underestimate the size of the market, and therefore, there's a lot of negative press around some of the valuation. But I'm reminded, and they've gone through definitely some issues now, but I'm reminded of the A2 milk scenario, that at $4 that A2 milk was up, a couple of 100%. But they reached $40, and because the massive underestimation of that end consumer market is just means that sales can ramp massively.
That's exactly right. So the end market for shoes and apparel globally is $1.8 trillion a year. So it is absolutely massive. If you focus just on footwear, it's about $400 billion a year. So again, just on footwear alone, it's huge. But it's important to know that Allbirds, although it's still mostly well known as a footwear company, it is very quickly moving into apparel. It's now creating kind of exercise gear, lifestyle gear, and sort of comfort clothes. And they're going right through sort of track pants type stuff to upper body as well. And that's only into year 2 of their sort of progress into that part of the market. But yeah, if I sort of move more towards the investment side of the thesis for Allbirds now, what really excites us is that the company has shown an ability to disrupt and innovate in what is mainly considered as a sort of more old and stale market. And I say that in the reason when people talk about disruption, innovation, they typically picture technology, they picture fintech companies, they picture cryptocurrencies, they picture stuff that's to do with digital and online. And that's because a lot of the disruption that's been going on has been technology driven in the terms of software or data. However, what Allbirds has shown to the market, that doesn't have to be all in sort of digital and technology. You can do that in shoes and clothing, and they've done an incredible job on showing how they can take natural products, appeal to customers through having a lower carbon footprint, and showing that customers really are willing to spend good money to buy these products. So the average Allbirds shoe has a carbon footprint which is 30% lower than any other shoe in the market on average. And that's something that really appeals to customers and people. It stands out, it creates a brand name, and people want to buy these products. And you combine it with their ability to be able to make a comfortable product which looks cool, it's got nice branding, and it showed how the sales can just really take off, which is what's been going on with Allbirds. And this is where I guess I want to touch on to the same company that Rob mentioned, which is Lululemon. Lululemon was not so much focused on kind of the renewable aspect and using natural fibers, but what Lululemon did really well was they took an industry which was dominated by Adidas and Nike, and they tried to do things a little bit differently. They tried to make sure their products were more comfortable, they were designed better quality, they lasted longer, they controlled the entire brand right from distribution. So you don't see Lululemon for sale in other shops, you see it in Lululemon stores and you see it for sale online. So they control the whole narrative of how the brand came across to the market, and that business has been amazingly successful. So Lululemon IPO'd in about 2008. It had a similar market cap to Allbirds, when Allbirds' market cap IPO'd 2 weeks ago of about $2 billion US. Lululemon now has a market cap of $60 billion US, and it has got an annual sales number of $6 billion US, and it has achieved an annual growth rate of around about 30% per year since 2008. And then to go sort of one step further, but this business isn't growing as fast, is Nike. So Nike has been amazingly successful over a very long period of time, but Nike's only grown its sales, give or take, around 8 to 10% a year. It's not growing anywhere near as fast as Lululemon and Allbirds, but it's also more established. It's been around for a very long time. It's a larger corporate, so it's harder for it to maintain the growth rate. But Nike has got a market capitalization of about $260 billion. So we're sitting here today, we've got Allbirds at $3 billion US, Lululemon $60 billion US, Nike at $260 billion US market cap. And what we believe the opportunity for Allbirds is to send itself on a pathway similar to Lululemon. And it has already shown it can do that for the last 5 years. So now it needs to continue on that pathway, which means it needs to continue to innovate, it needs to continue to raise its brand profile, it needs to continue to roll out its physical store presence and achieve these 20 to 30% annual growth rates. And if they can do that, there's no reason that Allbirds cannot be the next $50 billion company like Lululemon is, because they've already got a great track record behind them and an ability to innovate. We're cognizant that this is never a straightforward path. It's a competitive industry out there. You need to keep innovating to stay ahead, but we're confident that Allbirds have got the right management team and the right focus and the right drive to do this. Just one thing I find really interesting about the company is they're saying they don't actually have to work as hard to find new products to innovate with these days, because when they first started, they had to drive everything themselves. They had to come up with all the new materials. They had to go out looking all around the world for what different fibers they can take from plants or animals, such as with merino wool, and build it into a product. Well, now that Allbirds has got a reputation, they're finding people coming to them. So other scientists or research and development specialists around the world who come up with a great idea, they come to Allbirds and they tell them about the idea and say, look, can we partner with you to take this material we've got and build it into your products? And I guess that's just sort of an example of how once a business starts to get more established and get the brand, it almost becomes a little bit easier for it to carry on this pathway. One of the other things that we're really excited about is the fact that Allbirds is relatively early stage in its rollout of physical store presence. It's only got 27 stores. Most of these are in the US. They've got a few other in regions. Many people have probably seen the one in Britomart in Auckland. There's a couple in London, but most of it is still in the US. And these 27 stores compared to over 600 stores at Lululemon. And Allbirds has only just done it to roll this out is because they've got into a better financial position. They've got the cash to be able to do it because it takes money to set up stores. And in their first 27 stores, they've shown to have a massive sales benefit and also increase their online sales, because as the physical store gets rolled out, people see the stores, they then Google the company and they order stuff online. So that's going to be a massive driver for the company going forward. The second driver is continued innovation in footwear. They've got they're very well known for sort of comfortable lifestyle footwear at the moment, but they've recently started launching professional type footwear for running and exercise, and so far the uptake in that has been very positive. And the third key driver of their growth is the movement into apparel, as I mentioned before. So they're moving into sort of more lifestyle oriented apparel, casual gears, but so far the signs are looking really positive and for that potential growth vertical as well. The last thing I'd like to mention, and this is kind of a bit of a COVID-driven benefit, but since the world's been in lockdown, it's becoming more and more people working in clothes which are more kind of lifestyle friendly. You've probably seen less people wearing suits, more people working from home. Even when companies are going back to office, particularly in the States, there's been a trend of people wearing more casual clothing. So this appeals to a brand like Allbirds really well too, and that's why they're super excited about their growth perspectives over the next 12 to 24 months. I'll just touch quickly on sort of more multiple type based valuation. When Allbirds IPO, it came at a share price of $15, and at that point it was trading at an enterprise value to sales multiple, slightly more expensive than Nike, but a massive discount to Lululemon, and that's why we were so interested. So you had a business which was still fairly early stage, but with the proven growth track record in Allbirds, growing at 30% annual sales growth per year, trading at basically the same multiple of Nike, which is businesses only able to grow at about, call it 8% per year, because it's large and it's big and it's harder for it to grow that fast. And that to us didn't make a huge amount of sense. We would be willing to pay a higher multiple for Allbirds, given its much more exciting growth outlook, at least for the next sort of 5 to 10 years as it starts to reach a more mature level. Allbirds is also traded at a very significant discount to Lululemon, and we saw Lululemon as the key competitor, well, sorry, not really competitor, but the key comparable company in the sense, being it's sort of a nice high growth company. It's disrupting the existing sector, and it was coming at a massive discount to this company. So this is why we put a big order into the book, and sure enough, the share price took off on day one, and it's traded to a level which we think is more reasonable for its valuation. When it was up 90%, it was trading at actually a premium to Lululemon's multiple. We thought that looked a little bit excessive, so we haven't been buying shares on the market. We've been waiting for things to settle down, and the share price of Allbirds has come back about 30%. So now it's sitting around about Lululemon's valuation multiple, still trading at a premium to Nike. And we're starting to look at this as a more attractive level to potentially buy more shares. But Rob was a little bit right when he talks about volatility in these stocks can be a little bit elevated in that period post-IPO, because you've got new investors have all started trading the company. Some people are there for a short return, some are there for a longer return, and so you have various people buying and selling, and that can create volatility in the share price. For us, we're taking a longer-term view here. As I said before, it's a $3 billion market cap company versus $60 billion for Lululemon, and we think the real returns would be made over a 5-year period as the business continues to grow and take its annual sales number from $200 million up to a multi-billion dollar level. James, have you got anything else you'd like to add on all this?
No, I think, Andrew, that's a great summary. I think the one final thing I'd say is that accessing these IPOs is not straightforward, because everybody wants a piece of a hot IPO, and it's about the relationships that you have in order to be able to get them. And I think that's partly why we work so hard with our global partners to make sure that we're always on their mind when they're thinking about raising capital. And this was one good example where you, Andrew, have got a great relationship with JP Morgan, and we've got another IPO we're working on at the moment in a totally different sector, in the digital currency sector. And again, hugely popular, but the relationships that we've got will mean hopefully, we get a good allocation. So I think that's not to be sneezed at, because, these things are hugely oversubscribed when they've got the potential to do well. And it's not just about putting an order in, it's about also knowing the people that are putting the book together. So I think that's a really good reminder to all of us. But
we just had a question from one of our advisors, James, which I might respond to. The question was, what do you believe is stopping the likes of a Nike eroding Allbirds' intellectual property? Which is a really good question, right? So in the end, there's always going to be risk of competitors taking a smart idea. One, there is an existing intellectual property portfolio, which is very comprehensive at Allbirds, which will restrict Nike from using the exact same products to produce footwear. These IP portfolios tend to roll off over time. You can only protect them for so long, but at the moment that's providing some protection. Two is Nike isn't necessarily focused on getting, or at least at the moment, getting too much into all of this renewable new product stuff. They've got an existing business model which works extremely well through the way they market and the quality of their products. And so it actually takes quite a bit of retooling in their business to actually turn it around and try to get really innovative with all these new materials. And you sit there going, well, do they need to do that when their existing business models works extremely well, which is more of a sort of marketing and performance-driven business model. The third thing I'd point out, and this is actually probably the point which makes me most comfortable, is it's very hard for existing old businesses and brands like Nike to brand themselves as low carbon with using natural products and getting that interest from consumers to buy them because it's good for the environment. And I know that sounds a little bit fluffy, but it's true. Like if you think about yourself, would you ever go buy a Nike shoe because you think it's great for the environment? If you think of Allbirds, you would think the company is built from the ground up with an ESG and environmentally focused perspective. I'm going to buy that shoe to support a low carbon footprint. And it's not saying Nike won't be able to change that brand. It's just very hard to do so. Nike's got a 30, 40 year history built up of over sort of one line of branding, and it's hard for it to change it to someone like Allbirds has done straight away. And so I think this also provides some protection. But also, Rick, that's a good point, and it's always something that we have to watch, and that's why I said earlier on that Allbirds needs to continue to innovate. I mean, if Allbirds just decides, look, we've got a couple of great shoes now, and we're going to stop here and this is us, then the business will be, its growth will be slowing quickly in the next 5 years. But Allbirds is very aware of this. They continue to try to innovate, always bring out new products, and that's how you stay one step ahead of the game.
Well, Andrew, really appreciate your thoughts and the research insight that you put out. We'll watch it closely and looking forward to the journey. So thanks for your thoughts. And thank you everyone for joining this morning. I hope that gave you a nice insight into some other aspects of the market that we do focus on and our partnerships in order to be able to do that. And if you do have any follow-up questions for Rob from Goanna, do send them through. Otherwise, look forward to speaking again same time